Ritter.
Thank you, Madam Chair, and I look forward to the testimony as well. The specific title of this hearing seems to be market manipulation, and certainly I agree we need to ensure that that doesn't go on and have proper enforcement and rulemaking to ensure that. I tend to think active illegality or active manipulation is probably a small part of the picture, so I hope we also talk in a much broader sense about the role of speculation and what that has done to the market, particularly in the last year, and look at that as well. I think there is significant evidence that that does play a major role in at least the pace of the increases we've seen recently. I guess I disagree a little bit with Senator Dorgan that the fundamentals don't suggest a significant increase over time. I think a lot of fundamentals do suggest that, but not perhaps at the pace we've seen. So I hope we look at this as an important piece of the equation, and also not forget about the fundamentals, the increased demand from growing powers like China and India, and the need to address those fundamentals on the supply side as well. So I look forward to the testimony.
Senator Kent, well, let me just say, I didn't say over time. I talked about the fundamentals that exist today, a big difference.
Thank you. Well, let's turn to our witnesses. Again, we thank you for being here and making time in your schedule to give testimony on this important hearing. First, we will hear from George Soros, chairman of Soros Fund Management. He is a world-renowned ex-financial markets and recently published a book I found helpful, The New Paradigm for Financial Markets, the Credit Crisis of 2008 and What It Means. Mr. Soros, thank you for being here today, and we look forward to your testimony.
Thank you very much.
And if you could just turn your microphone on and maybe pull it closer to you so we can capture your...
I'm very honored to be invited to testify before your committee. As I understand it, you are seeking an explanation for the recent sharp rise in the oil futures and in gasoline prices. In particular, you want to know whether this rise constitutes a bubble, and if it is a bubble, whether better regulation could mitigate the harmful consequences. In trying to answer these questions, I must stress that I'm not an expert in oil markets. I have, however, made a lifelong study of bubbles. So I will briefly outline my theory of bubbles, which is at odds with the conventional wisdom, and then discuss the current situation in the oil market. I shall focus on financial institutions investing in commodity indexes as an asset class, because this is a relatively recent phenomenon and it has become the elephant in the room in the futures market. According to my theory, every bubble has two components: a trend based on reality and a misconception or a misinterpretation of that reality, of that trend. Financial markets are usually very good at correcting misconceptions, but occasionally misconceptions can lead to bubbles because they can reinforce the prevailing trend, and by doing so they also reinforce the misconception until the gap between reality and the market's interpretation of reality becomes unsustainable. The misconception is recognized as a misconception, disillusionment sets in, the trend is reversed. A decline in the value of collaterals provokes margin calls, and distress selling causes an overshoot in the opposite direction. And the bust tends to be shorter and sharper than the boom that preceded it. Now, this sequence contradicts the prevailing theory of financial markets, which is based on the belief that markets are always right and deviations from equilibrium occur in a random manner. The various synthetic financial instruments like CDOs and CLOs, which have played such an important role in turning the subprime crisis into a much larger financial crisis, have been built on that belief. But the prevailing theory is wrong. Deviations can be self-reinforcing. We are currently experiencing the bursting of a housing bubble and at the same time a rise in oil and other commodities which has some of the earmarks of a bubble. I believe the two phenomena are connected in what I call a super bubble that has evolved over the last quarter of a century. The misconception in that super bubble is that markets tend towards equilibrium and deviations are random. So much for bubbles in general. With respect to the oil market, I believe there are four major factors at play which mutually reinforce each other. First, the increasing cost of discovering and developing new reserves and the accelerating depletion of existing oil fields as they age. This goes under the rather misleading name of peak oil. Second, there is what may be described as a backward sloping supply curve. As the price of oil rises, oil-producing countries have less incentive to convert their oil reserves underground, which are expected to appreciate in value, into dollar reserves above ground, which are losing their value. In addition, the high price of oil has allowed political regimes which are inefficient and hostile to the West to maintain themselves in power, notably in Iran, Venezuela, and Russia. Oil production in these countries is declining. Third, the countries with the fastest growing demand, notably the major oil producers, China and the other Asian exporters, keep domestic energy prices artificially low by providing subsidies. Therefore, rising prices don't reduce demand as they would under normal conditions. Fourth, both trend-following speculation and institutional commodity index buying reinforce the upward pressure on prices. Commodities have become an asset class for institutional investors, and they are increasing allocations to that asset class by following an index buying strategy. Recently, spot prices have risen far above the marginal cost of production, and far-out forward contracts have risen much faster than spot prices. Price charts have taken on a parabolic shape, which are characteristic of bubbles in the making. So, is this a bubble? The answer is that the bubble is superimposed on an upward trend in oil prices that has a strong foundation in reality. The first three factors I mentioned are real and would persist even if speculation and commodity index buying were eliminated. In discussing the bubble element, I shall focus on institutional buying of commodity indexes as an asset class because it fits so perfectly my theory about bubbles. Index buying is based on a misconception. Commodity indexes are not a productive capital. When the idea was first promoted, there was a rationale for it. Commodity futures were selling at discounts from cash, and institutions could have additional returns from this so-called backwardation. Financial institutions were indirectly providing capital to producers who sold their products forward in order to finance production. That was a legitimate investment opportunity. But the field got crowded, and that profit opportunity disappeared. Nevertheless, the asset class continues to attract investment just because it has turned out to be more profitable than other asset classes. It's a classic case of a misconception that is liable to be self-reinforcing in both directions. I find commodity index buying eerily reminiscent of a similar craze for portfolio insurance, which led to the stock market crash of 1987.